Get ready before life happens. The podcast helping you navigate life's what ifs.
Welcome to the Get Ready Before Life Happens podcast, helping people navigate life what ifs. Today, I'm joined by Michael Ervolini, author and active management thought leader. Michael, welcome to the podcast.
Well, thank you, Tony. It's a pleasure to join you and your viewers, and I look forward to today's conversation.
Yeah, myself as well. So let's get into it. Tell us a little bit about yourself and your origin story and how it led you to applying the principles of behavioral finance.
Okay. Well, for virtually my entire career of 35 plus years, I've been in the world of asset management in varying roles. Uh, but for the past 20 or so years, I have been the founder and CEO of two companies that are often referred to as fintech companies. We've developed analytic software for financial analysis. And in particular, I focused on helping institutional portfolio managers make better decisions. So I had one in the fixed income area and more recently in equities. And that equity product was designed to review decisions that portfolio managers were making and help them isolate which of their decisions, not individually, but as groups, tended to lift portfolio results and which dampened it. And as you could imagine, when you get into that, you start thinking about, oh, behavioral science offers some great opportunities. And when we began, behavioral finance really was more of a research area, really hadn't been applied in any clear, specific way to help people make better decisions. So we integrated some behavioral finance into what we did. And the result of that is we were able to help both portfolio managers and their clients, sovereign wealth funds, pension funds, endowments, and others, understand some key elements about fund managers that really had never been explored before, and they had to do with skill. And you would think everybody understands skill, and of course it's talked about a lot, but the analytics that are generally available to all of us, whether we're using a fund rating service or talking to a financial advisor or wherever we're getting our information, these conventional analytics look at two elements of a fund. Its return series and its daily holdings. And the computations done on that data provide a lot of information, but they really don't get the skill. So once we got into the skill area and started to look at tendencies, we found that there were skills managers had that were very, very productive, and other tendencies, we'll call them behavioral tendencies, that undermined what they did. And so that really is how we got there. And then as I saw, what we had learned looking at thousands of portfolios, it led to writing my first book, which is called Managing Equity Portfolios, a behavioral approach to improving skills and processes. And that really lays out a lot of behavioral concepts and talks about how they interact with decision making at the manager level or the individual investor level for that matter. And so that was really the process. And I've stayed in the area of decision making under uncertainty, which also includes behavioral stuff, ever since then. And it's just been tremendous to see how we could take some of these pretty amazing studies that have been done through research and apply them in ways that can help everyday people, portfolio managers and individuals, as well as capital sources, just understand better about what's going on and make better decisions. So that was my process. It was more from a business perspective, backing into behavioral finance as opposed to a pure academic pursuit.
Well, that's really fascinating, because I think this is starting to be the conversation. Most of my guests are people who are dealing directly with clients themselves, but that looking at it from the same overview is that we are oftentimes led by our money stories and our backgrounds and our experiences, and they impact what we do. So, as you started to work with the fund managers, were you seeing an uplift in performances once they understood how their behavior was impacting their management?
Very frequently. Fund managers, as you sure understand, are as distinctly individual as the rest of us. And so many, I should say, of the managers really internalized what they could learn from the analytics. And it would only take one or two small changes and they could see big improvements. An example, a manager would be really, really good at buying stocks. So when we analyzed their history over 5, 10, or more years, we could show that not only did they in general buy stocks that did better than the benchmark, but they did it pretty consistently. Maybe 12 out of 13 years, their buying was very, very successful. So they're very good. And often they captured the full benefit of those buys. But in some instances, they would sell too quickly. So they made a great decision to buy. They put enough capital behind the stock, but they sold it maybe 6, 12, 18 months too early. And again, we're not talking about just anecdotally one or two. We're talking about a statistically meaningful group of them. And they might have a certain characteristic. They might be more volatile than the rest of the portfolio, or maybe some other metric was concerning to this person. And so they thought it was a good time to sell. But what we were able to show in the analytics is that by making these premature sales, they were losing 50, 75, 100 basis points. And so what the managers would do in a situation like that is they'd simply put in a roadblock in their process. When either my analyst comes to me with a sale recommendation or I have a concern about a stock and it has these characteristics, let's slow down. Let's think about, why do we really want to sell it? Are its fundamentals really changed? If we had the option, would we buy it today? Asking all sorts of questions to counter their desire to sell. And what we've seen is lots of improvement. Now, it might be 50 or 75% of the opportunity that was observed, but if 100 basis points are available and you capture 60 or 70 basis points of it, it's a huge improvement to the fund. So we have seen lots of improvements in managers that have been able to internalize and be open to change. Many, if not most, are, but there are some that find it difficult. They are just wedded to the way they were trained and the processes they use today. But that, I think, is true in every profession. There's a large group of people that are open to change and some that aren't. And the market kind of sorts that out over time.
Yeah, definitely. The market is always a decider. I think what you said, though, is so important, is to slow down and think about why you want to take a specific action. I mean, whether you're a fund manager, whether you're a financial planner, whether you're just a consumer,
Mhm.
that's just good advice in general, even outside the money world, is think about
Yeah.
what you're doing and why you're doing it. So that's powerful advice. And of course, I start thinking about Warren Buffett and Benjamin Graham, two guys who are, we'll say successful in the financial world, is that I think, when you read Warren Buffett's annual letter and Charlie Munger, when he was writing his letter, that they talked a lot about these things and that had an impact. I mean, did you find that Warren Buffett and Charlie Munger were really sort of incorporating these things without really calling it behavioral finance?
Uh, I think from afar, because I've never analyzed their portfolio or spoken with them, I would say yes. So they have developed the wisdom of being, one, sticking to a very focused strategy. Right? There's a certain kind of company they like to own, and they establish what they think is the fair price to pay today. and they wait. And if the market goes up, they don't buy. And when the market comes back down, they buy and so forth. And they tend to buy companies that they believe have a long run in them, so they don't have to think about selling immediately. But the processes they use sound like, from everything like you that I've read in their annual letters or other reviews, are that they're pretty self-aware and pretty cautious not to overreact. And so what that leads to is, what are the two things that people are not aware of that drive most human decision making? Okay, these are things that are not discussed in school when we're learning finance or economics, and they're generally not discussed in many meetings in the financial world. And those two drivers of virtually all decisions are your unconscious and emotions. And the unconscious is particularly important. Researchers believe that well in excess of 95% of all the decisions each of us makes every day are driven entirely by our unconscious. That means we're making decisions with no conscious deliberation. Now, that's extraordinary because that's not how we view ourselves. We think of ourselves as being objective and rational and all those other kinds of words. But the fact is, the unconscious brain, relative to the conscious part of the brain, is bigger, more powerful, faster, and more persistent. And so it's dominating decision making all day long. Whether they're big decisions or little decisions, the unconscious is going to get there first. In fact, the unconscious, the brain usually makes a decision before consciously we're even aware that a decision is needed. And the reason is twofold. One is conscious deliberation is very expensive. The human brain represents about 2% of the body weight. It consumes about 20% of all the calories during the day. And so conscious deliberation is the most calorie consuming way we think. So our default is, unless we really push the conscious brain to focus, the unconscious is going to do the job because it takes less energy and it's therefore more efficient. That's one reason. The other one is more natural selection. If we think about individual many, many years ago when early man was around, if a person was walking down the path and heard the rustle of some leaves, what would they do? Well, one possibility is to look around and see if that sound was a predator about to pounce, or was it just the wind? The other answer, the one more likely, is that when that person heard the rustle of the leaves, they ran. Okay? And those that learn to run the fastest, well, they became our ancestors. And so through a series of episodes like this, we, as humans, develop the ability unconsciously to identify, interpret, and react to information. As I say, even before the conscious brain knows a decision is needed. A classic example is when any of us steps out on some slippery or icy sidewalks. Before we know it, our shoulders are up, our bodies are tense. We don't even know what happened, but our body does, our unconscious does. And that kind of automatic reaction is great for survival in a lot of situations. It's not necessarily the right approach in modern life when we're dealing with volatile markets or uncertain pricing or other kinds of modern stimulation that might fool our unconscious into thinking it knows what to do, but it's actually going to make a decision that's going to undermine our real intention. So being aware of the unconscious is very important as you want to become a better investor, just recognizing that's one reason to slow down. The other is emotions. Oftentimes when you hear somebody speak, particularly a fund manager, you hear, oh, in our group, we've taken all the emotions out of our decision making. Everything we do here is completely by the numbers. Well, Tony, as we like to say in academia, that is poppycock. No one does that. And the reason is very simple. What neuroscience tells us is it is completely impossible to make a rational choice without emotions. So I'm going to say that again. It's impossible to make a rational choice without emotions. So contrary to all this bluster about I'm not emotional, the real avenue for success is understanding where your emotions are leading you towards your best choices and where they're not. And emotions are really big in creativity and problem solving and thinking. So how do they come into play? Well, you're thinking about buying a new mutual fund for yourself. Well, there are many, many places you could go to get background information about that mutual fund, its performance, how people think about it, how one group assesses it relative to its peers versus another group. Which information source or sources you pick, well, there's too many to consider, so you're going to have to make a selection of them. Those choices, they're not completely objective. Part of it is I've got 10, I can only really look at three. I'm going to go with these three. Well, somewhere in there was those three were elevated for reasons you're not even sure about. That was your unconscious and your emotions helping you make that decision. And then when you get into them, if they're conflicting a little bit, one resource says, I like fund A more than fund B, and the next organization fund rating service says, I like B more than A. How do you know which one to go with or how to weigh them into your final answer? Well, all those tie-breaking kind of decisions, there's a little spark that happens. That's emotions. And so as we think about using what we've learned about behavioral finance and applying it just in a day-to-day process, the important two elements that I underscore for folks I'm working with is the unconscious is playing a much bigger role in your decision making than you're aware of. And your emotions are not to be dampened to the point where you think they don't exist. Instead, your decisions are to be studied so that you know when your unconscious and your emotions are leading you towards your best decisions. And in the instances where they're leading you towards unproductive decisions, that's where you change your process and try to harness back those impulses and redirect them in a more positive way. So that's really how you apply behavioral finance. You study what's been going on, what works, what doesn't. You do more what works, and you try to somehow retool what's not working. For some managers that have large number of positions and lots of turnover, it's a challenging task for sure. For some of us who are making a lot fewer decisions, it can be much more manageable and done much more with a pencil and paper.
Well, that's fantastic. I mean, I think that's something, I encountered as a consultant over the years is trying to understand why somebody would make a certain decision or not make a certain decision when it came to making a move, even though it would seem crystal clear what what I considered the right decision would be, and there'd be something holding them back. And it wasn't a question of education, it wasn't a question of comprehension, that it was a question of, as you point out, the unconscious decisions that are going on. So, as we talk about it, is how can you become more aware of your unconscious decision making and start to maybe not change a narrative, because you may not be able to change a narrative, but at least take it into account what your unconscious brain's doing.
Right. So I'll draw a line. There are people that I've worked with that have robust accounting systems and lots of historical data. when we're working with folks like that, there are analytics that exist, and there are a number of companies around the globe now that do this. They analyze portfolios for what I've termed decision-based analytics. And so they try to identify groups of decisions that are productive and groups that are less productive. For the rest of us, whether you're a financial advisor or an individual investor, the number of decisions we're making is far less, and the information we have to work with is not quite as digital. And so there, what many people have done successfully is just use a diary. Just whether it's a spreadsheet or a Word document or a piece of paper, just write down, okay, here's the date, here's what I'm thinking about doing. Here's some contextual information. The market's up, the market's down. My portfolio relative to the market is doing well or not so well. I'm feeling optimistic, I'm feeling glum. Put some contextual information in there. And then talk about what it is. These could be all terse notes, of course. It doesn't have to be paragraph by any stretch. What it is I'm looking at, what data I looked at, who else I talked to. Did I check it with my uncle? Did I check it with my colleague? How did I confirm that my thinking was reasonable? And then what my choice was. And then when I made the choice, did I go into it on a gradual basis? Did I decide to make a big position move immediately? However I went about it. With that kind of information, then what you could do is periodically, let's say once a year, go back and look at those and try to put together either a table of information or even just a scatter diagram, points on an XY plot. What worked? What didn't? What can you abstract from that? And over time, you'll begin to see that there are times, maybe I'm way better at getting out of funds than I am at getting into funds. Maybe I'm a lot better at getting into index products than I am active management products. Maybe I'm better when I buy individual stocks where 3 or 4 of my trusted advisors are into them as well, as opposed to when I go it alone. There's things that you can begin to learn. And then when you deviate, let me back up and say, when you approach a decision that looks like the kind you typically make well, you can feel reasonably confident that if you stick to your process, you'll make another good decision. And when you come to an opportunity that deviates from those, it looks like the kind that, too many times I've made the wrong decision when I did this. You have a choice. You could say, I'm not going to do it again. Or this time, I am going to check, not with 3, but with 5 people. I am going to really put a tiny position in and watch it for a few months and see if it hits a milestone or two to give me further confidence that I've not made another mistake. And so there are very simple, straightforward strategies. These are, by the way, all described in the first book I mentioned, Managing Equity Portfolios. It's available on Amazon. The publisher is MIT Press. And in the back of the book, section 3, there are about 10 very clear process enhancements that anyone can use to improve their decision-making processes, from learning more about themselves, what I call becoming more self-awareness, to debiasing or eliminating an unproductive tendency. So if anyone interested wants a little bit more help, that book's out there and available. So those are the kinds of things that people can do, and they work. They're borrowed from the same kinds of approaches people use to improve their tennis game, to improve how they perform surgery, to improve how they land a jet on an aircraft carrier. All high performance activities are based on constant improvement, and that improvement is incremental, and it's based on a reasonably clear understanding of what's working and what's not.
I love that. It's funny is I was thinking of, in the military, they call it a hot wash or whatever, I think, but that you have to go back and look is, I used to do wilderness first response,
Mm-hmm.
and we would always have a debrief after an incident and, get together and, essentially talk about what worked, what didn't work, what was our process.
Mm-hmm.
And it sounds like that's exactly what you're talking about is exam, like, why did we do this? What worked, what didn't work? And it was incredibly helpful to be able to do that and analyze the process that we went to. We didn't write it down because we tried to do it like as soon after as we possibly could. So
Right.
everything is reasonably fresh. But I love the idea of writing it down because then you can come back to it in a little while, or as you point out, months later and refer back to it. Because I think with our money and as you point out, with our decision-making framework beyond that, is we don't revisit. We forget what happened, then we do the same thing again and go, oh, that's right, that happened last time I did that. So I love that concept. And for people watching and listening, there will be a link to Michael's book. So you'll be able to find it on Amazon and check it out for yourself if you have access to the show notes. Um, so Michael I think, one of the last questions before we wrap up is,
Sure.
why is it important to slow down and take a breath when making financial decisions? I know you've talked about it a little bit. Can you just go more into, maybe the science behind that of taking a deep breath and what that does for you?
Sure. Well, a big part of it relates to the earlier point of the unconscious. It's going to pull you in a direction well before you even know anything's happening. And so then you're at a point where you need to fight your own intuition, if you will, and that's hard. Um, so that's one reason slowing down is good, is because it gives a chance for whatever first impressions you have to just wash over you before you lock in and accept them too much. And the other is emotional. A good example in that area is someone buys, let's say, an individual stock, and they really think that this is going to be a great stock, and it will make up some numbers here. They bought it at $50 a share, and they think it has a real good chance of going to like two, three, $400. Well, they buy some at 50, and then the next day it's already at 60. Well, some investors, individuals, would say, wow, that is great confirmation. I'm going to double my position today. That sounds reasonable. Other investors, and I've seen this clearly among professionals, when that happens, even though they wrote down when the confirmation comes, I'm going to increase my position substantially, they hesitate. And the reason they hesitate is there's a little fear in the back of their minds that says, wow, Mike, I bought this yesterday at 50 and today is at 60. If I double my position and tomorrow it goes back to 50, I'm going to feel like a loser. So let me just wait a little bit longer. And then what they find out in a few days, it's 65, and then it's 70. And then finally, they buy a little bit more. And what they wind up doing with certain kinds of stocks is they chase them in a very slow way, and they don't get anywhere near the full benefit of the research they've done, that if they had made a slightly more aggressive building up of the position earlier, they would have made a whole lot more money. So slowing down and thinking about what you're doing can help you avoid overreacting because something makes you feel super happy or super nervous, but it can also give you the courage to not underreact and make sure that you stay with your discipline. So one of the things I'll add here is, in a parallel to behavioral finance, is a little newer, but now 15-year-old theory of investigation referred to as emotional finance. And it was developed by two researchers out of the UK, Richard Tafler and David Tuckett. And what they have done is they've taken a couple of basic psychoanalytic concepts and applied them to investing. And the essence of it is this, in that Freud believed that many, if not all decisions we make, we're seeking pleasure and avoiding pain. And of course, in finance, it's called greed and fear. But seeking pleasure and avoiding pain is a much more subtle process. Because if everybody else is plowing into something, well, you're thinking, well, that stock could help my portfolio. And so the idea of buying it and having it lift your portfolio is really seeking pleasure. It's not necessarily greedy. It's just you want to feel good about your portfolio. And avoiding pain, sometimes we see it particularly in professionals and retail investors. You own a stock that goes down and you're just uncomfortable selling it. Why? Because if you finally get out of it, you have to write off what you've lost, as opposed to what people euphemistically refer to as a paper loss. Well, once you write it off, then forever, that position you purchased is a loser. And emotionally, maybe I feel a little bit like a loser too. So oftentimes we hang around with stocks that are down for way longer than we should to avoid that emotional thing. So in all these instances, if you have the word that you used repeatedly on our last topic, a process. Here's how I get in. Here's how I get out. Here's what I think about when it goes up. Here's what I think about when it goes down. If you have some simple rules, and that's all the process is, some simple rules, that can help you overcome some of these tendencies. And rather than allowing them to propel you into action or inaction, good decisions or bad decisions, try as hard as you can to follow those simple rules. And again, think about them, look at your own portfolio to help you develop them. And by all means, read books from the masters and see what their rules are, and talk to people that you think are pretty good decision makers, and use all that information to hone your process or your rule set. And if you're able to do that and able to slow down and follow those rules, two things happen. One, by slowing down, you make decisions that are more consistent with your intention instead of the way you feel at the moment. And two, if you make most of your decisions consistent with that process, you'll learn over time how to improve because you know where the decisions came from. Maybe this part of my process needs some refinement. Maybe this part of my process I can loosen up a little bit. But if you're not following a reasonably clear process, not a rigid one, but a reasonably clear one, it's hard to improve because every decision in your mind becomes unique and you can't see any common characteristics to work with. So that's another, I guess, secondary benefit of having a process is it provides the platform from which you can learn and improve. And all that is related to just taking a moment and slowing down. If the decision is that urgent, maybe you shouldn't be making it. One of the adages that I like to use in my decision making is if it's urgent, it's probably not important.
I love that. And immediately I started thinking about scammers because that's one of the things that they do is they put on that urgency, like you have to act now, which is 100% a warning sign. So
Yeah.
I love what you said is slowing down is so important. So Michael, to wrap up, we have what I call the Get Ready Hot Take Trio. These are 3 quick questions, rapid fire, that I ask all of my guests.
Okay.
The first one is, what is one money myth you're trying to break?
A money myth that where I'm trying to break, I guess that would be that all the decisions you make do not have to be wealth maximizing. It's perfectly reasonable that some of your decisions are about psychic reward. An example would be home ownership. You know, should you have a mortgage or not? Well, some people think if you can borrow money at 4 or 5% for a mortgage and invest it in the asset markets, why not? It's a way of making more money on your investments than you're paying on your mortgage. It seems like a no-brainer. Other people, and I think this position is totally legitimate as well, is if I pay off my home on some deep level, it makes me feel secure and happy. And it might not be wealth maximizing, but it makes my entire life more fun and more balanced. So not every decision we make has to be uh, wealth maximizing. Should be wise, but it doesn't have to be wealth maximizing. So that would be my answer for that.
I love it. And I always say, you don't have to give up your daily coffee. You know, that's such hot advice. So, Michael, the next one is let's get out the time machine for a minute. If you could go back in time, knowing what you know now about money, what advice would you give your younger self?
That is easy. Save, 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 and save some more. I think far too many of us begin saving far too late in life. And the freedom, the degrees of freedom that come from having just a little bit of a nest egg, even in your 20s, is enormous. And of course, it compounds, as we all know. So the earlier you save, I think the better off you are. You develop the habit, you get some early modest financial security, some degrees of freedom about which career path you're going to take, whether you're going to take 6 months off to go back and get some retraining. You just have more degrees of freedom. And then over time, you can learn how to invest that money more and more wisely. But I think learning how to save and being good at it and persistent at it, I think is advice I wish I had absorbed when I was, let's say, 18 or 19 or 20. And it's something now that I certainly uh, provide to other people when they ask about what it is the most important thing. And I think it's saving more. And investing is important, but saving is number one.
I love that. And that is by far the most popular answer to that question on this show with
Oh,
all of my guests.
okay.
So it's like, it's it. So the last question is, what's your number one tip for changing the way we think about money?
We're changing the way we think about money. Well, I think money and emotions are pretty hard to separate. So what do you do about that? Emotions can make you overactive with your investing or avoid it. They could cause you to save a lot or cause you not to save because you think some emotionally you're thinking, what's this 10 or $15 a week going to do? It's never going to amount to anything. Or I don't have to maximize my 401k and get the employer contribution or whatever it is. So part of it is trying to recognize that emotions are playing a role in our money thoughts and decisions. And so the two things you can do there, one is only address them periodically. Once a year might be enough. Too much, and it's just going to annoy you and you're going to want to not deal with it. So once a year is plenty. It could be more, but once a year is fine to look at your portfolio and think about things. The other one is to talk it through with someone. It could be a certified financial planner. It could be somebody at one of the big investment houses that is running the 401k platform in your company. It could be just somebody you trust. But getting someone else to hear what you're saying does two things. One is, and this is certainly something I found, when you try to explain something to someone outside of your own mind, it causes you to think about it a little harder. You don't want to say anything as dumb as you'll think. So that's a benefit right there. And two, if that person really is pretty thoughtful, then they'll help you question that last thing you said. do you really understand that as well as you just said it did? And so I think managing the emotions, and my two short responses for that are do it infrequently, or at least once a year, and then try to do it with someone that you think could help guide you, not give you the answers necessarily, but guide you towards making your best decisions.
I love it. That's wonderful advice. So, Michael, where can people learn more about you and where can they pick up a copy of your books?
Okay, so the best place to learn about what I'm up to right now is I have a website. It's www.skill versus luck, all spelled out as one word, skillversusluck.com. And that has information about me and what I'm doing right now in trying to help uh, investors and asset owners better understand the skill of the managers they're considering or have allocated to. It also has links to my books and a series of essays and articles that I've written, um, which I think many of your audience members would find interesting. And both books, my current one and Skill versus Luck and Managing Equity Portfolios, are available again through Amazon. And so that's the best way to reach out. And of course, there's a way of reaching me through LinkedIn or through the website. If somebody has a specific question, I'd be happy to address it.
Fantastic. And for everybody watching and listening, there'll be links. All these links will be in the show notes, so you can go to the show notes if you have access to them. So, Michael, thanks for joining us on the Get Ready Before Life Happens podcast.
Well, Tony, it's been a pleasure, and thank you for inviting me.
Yeah, and thank you everyone as always for tuning in. If this episode helped you change the way you think about money, please be sure to subscribe and to tell a friend. You can also go to my website at tonystewart.com to join the Get Ready movement and get access to my newsletter and a whole bunch of free resources. Until next time, let's change the way we think about money.